what's about your weekend or your week, your classes?
They were chill, but we are starting to have exam next week.
Next week, okay. Or of which class?
Fianzas? How you say it in English?
Surety.
Could you repeat it?
Surety bond.
Oh, sure, it's Yvonne. Yes.
So who is teaching surety?
Peñuelas.
Uh, he knows? Oh,
But easy because the evaluation um is going to be a exposition.
okay.
So mhm.
So, got it. If you need something about surety or bond is used for the same to refer as a contract, but bond as a government bond of CETES means like the formal and individual contract. So it's like policy in insurance. So you say bond to say fianza for a policy, and to refer to the operation of fianzas, you say surety. And if you want to say pólizas de fianzas, you say surety bond. Okay. So regarding that, if you need something about that, of course, I can help you or support with any comment or doubt. Or Hansel. Hansel works with me in risk management in the surety company of Tokyo Marine in Mexico. So he knows a lot of that. Also, Maddie, I think you know Andrea Madalay. She works in actuarial in surety with me. So you can approach with both of them to maybe share some doubts. And if they do not can clarify, you can approach with me. Okay.
Thank you.
So and the other guys sleep all the week or what's going on?
Well, I have two birthday parties yesterday, so I'm a little bit tired, but it's okay.
You know, I'm too tired because not both the parties because I have a lot of work, but
Also work.
sorry for last Thursday. I have a call with Tokyo, so with the difference of hours was complicated to change the schedule. But I hope you use these 2 hours to review the practice, because in general we complete the review of the first unit, which is macroeconomics and the application through linear regression models. Uh, so you have chance to use this maybe the beginning of next class to share any doubt or comment about the practice, but that's the last 2 classes that we will talk about this. Uh, as I comment, you should deliver. I don't know if it's already published, but I think yes. Uh, practice macroeconomic models. Ah, ya entregaron dos, wow. 4. Good. No dice cuándo. Nice. Curious. Oh, sí. Okay.
Sí, creo que la asignación no tenía fecha, ¿no? O sea, por lo visto. O sea, no se veía ahí la fecha. Dice,
Okay, it's something I'm seeing. Okay. So it's open, but will be assessed as 100% if you deliver before March 31st. That means you have all the month of March to deliver. If you deliver after March, salud. If you deliver after March, it means in April, the maximum grade that you could have is 8. If you deliver after April, it means in May, the maximum grade you could have is 6. If you do not deliver, you have 0. Okay, it's clear for everyone?
Yes, but I have a question.
Yeah,
Uh, Everyone in on the team has to deliver the task, or just one person?
just one person. In the document, you should put the name of the person, the 3 persons, and the others should marked as delivered.
Okay, thank you.
You're welcome. Something else? Comment or questions?
Mm, I don't think so.
Okay. Okay, so if that's the case, we will start with financial risk management, which is the second unit of the class. Uh, and before I start, I would like to know, what do you know about financial risk management?
Financial what?
Financial risk management.
Well, I
Mm,
think there is two risks that are, teach in administration de Sacoren. Uh, One is risk market, and the other one could be, I guess, I don't know, riesgo de contraparte. The
Counterpart, counterparty risk is financial risk also.
okay, contraparte, and well, there are like metrics to this risk, but the one that I think is the main one is the value at risk. So well, I think we should use the value at risk, you know, um, and financial risk management. That's what
Okay,
I think.
thank you. It's more or less the idea. Do you take class with me in actuarial risk management? Actuarial management?
No, I didn't. I checked last week, chemistry, but I also know that you probably teach about that. So well, I don't
Okay.
know.
Yeah, I gave last semester the class. So I asked the question because it feels like you have confusion. So I said, oh my God, I can explain well risk. So let's start with that. Just as a quick reminder. And after that, we can't comment about financial risk. But I don't know if someone raise the hand. So Hansel, that's tricky because you work in risk management, man. it's the process of the identifying and also analyzing and making investment decisions based on the potential of losses. More or less, more or less. But yeah. Okay, perfect. Thank you, Hans. So let me explain for all your other classmates. And something important here, since I am very familiar with these terms, I tend to speak fast when I am teaching these kind of things. So please let me know to try to speak slowly and clearly. Because, for example, I can say when I am focused on explaining clearly, financial risk management. But if I'm speaking fast, I say financial risk management. So probably you do not catch well the things that I am saying. So please let me know. I don't know, right? Say turtle, something like that, to know that I should speak slowly to be very clear. Okay? Well, so before I start with the, okay, how can I do this? Okay, perfect. So before I start with the normal class, we will make a super quick review of risk management introduction that I used last semester just to have all the same understanding. Do you see my screen?
Yes.
Yes.
Okay,
Yes.
so I will not share this presentation because it's from other class, but just to everybody stay okay. So what is the risk? First of all, what is risk? And risk could be defined as an event or a condition with uncertainty that occurs, that when occurs, there is an effect in an objective and a goal or in a project, and this can generate losses in the value of the assets or the capital. So you can read the definition in Spanish. I think it's easier for you. But what I want is that to understand that risk by themselves is an event that, if occurs, could generate a different result than the expected. And it means the second definition, that it is the most modern definition of risk. It is also called the probability of something happen, that when something happens multiplies the cost or the benefits if it is materialized or if it is happened. So this is the most wide definition of risk. And what I do not like from this is that they are saying that risk is a probability. Could be defined as a probability in a mathematical way, but in that term, you already measure the risk. And risk is a more complex situation. It is like from my point of view, it's a space of probability. So you have ¿cómo se dice conjunto?
Joint.
Joint is joint?
Set.
Yeah. You have a set of events, which each event have associated probability measure. And then you have the probabilities of each event happens. So if you define in that way as a space of probability, the risk, I think that's risk. I have several events with associated probabilities with a measure, and that is the risk. And if the event one happened, I have a result with some probability. So the consequence is also part of the risk, but that is wider than the probability space. So that's why I think it's difficult to define risk in mathematical. It is easy to set mathematic formulas to say that it is probability, but it is more than just the probability. It's like the relation or the functional relation between event and results, which is the one that says in the second definition. Cost, the multiplication of the cost or the benefit after the event happens. Very nice definition. I have never seen in that way, but since I am trying to explain more in English, was a good definition. I will write it. So until here, clear for everyone?
Yes.
Yes.
Okay. So just this part. The depending on the way that we are exposed to some kind of risk, the main classification that we could have in all the text articles bibliography is the following one. We have discretional risk and non-discretional risk. Does anybody can explain me what is discretional and what is not discretional? So take 5 minutes to review all the words or the kinds of risk that you have here to try to participate. And then if nobody participates, I share with you the first one's discretion, explain difference between discretional and non-discretional, and then explain the financial risk, which it is our today topic. Okay? So 5 minutes. Come back in 5 minutes. Yes, Natalia, Sofia.
Mm, yes, I understand that the difference is in discretional. You could have, uh, I mean, you could take the decision like to elevate the interest rate in, I don't know, credit risk credit, and you can have like a profit in one, in the discretional, but in the non-discretional, it is a risk that is under our control, like a reputational or legal, and I think that you could only have losses in the non-discretional.
So. It is a well understand, but there is limitations in the definition. Tello, uh, or Cruz.
Well,
Yes,
I you go first.
thank you. What I understood was that the discretional um, is the risk that you put yourself into, and
Yeah.
the non-discretional is the one that is happening always um, in operating your business. And no,
Yeah,
ah, eh, and yeah, that's it. Thank you.
perfect.
Yeah,
Perfect
I also
explanation.
agree with that description. But I think discretional is a good example about when we talk that risk. Uh, there are some good risk that we can take and can make us like good profits.
Uh, It's usually noted as one of the risks where you can have high profits. It's something relevant, but not always, because the benefit or the losses are not linked with the nature of the risk. So, okay, thank you for sharing. I think it's a very well. Let me share with you uh, an example different of the other classes. We have, I don't know who plays tomorrow. Sports. ¿Cuánto quedaron los Pumas ayer, by the way? ¿Perdieron?
Dive
No,
one
no.
one.
Empataron, cabrón. Al menos iban perdiendo. Esos dorados. So, for example, today we have Toluca Chivas at 5 p.m. in Toluca. By themselves, for me, I don't know for you, but for me, it's not a risk that much because I do not support Toluca either Chivas. Maybe I will see some friends that support Chivas, so I have the risk that they get angry because Chivas probably lost the match. So if I see my friends, I have the risk, discretion, non-discretional risk that maybe they hit me because they drink when after the meal and see the match and the Chivas lose. But probably Chivas could win and they maybe buy to me a shot of tequila. So do you see that could have positive or negative result this event? And it is just a risk if I saw if I will see the match with my friends. Because if I see alone in my house, nothing happens to me. So it's discretional if I decide to see the match with some fans of Chivas. That part is discretional because I decide to expose myself. to the reaction. But it is not discretional what will happen and the results. And will be discretional if I make a bet in caliente. That's discretional because I decide to put my money in favor of Toluca, for example. Is it clear, the example? Is it the same event with a discretional risk and a non-discretional risk, and also non-risk?
Yes.
Yeah, it's pretty clear.
Okay, perfect. Perfect. I should write a book about risk management because I have very good ideas now. So if somebody wants to make a thesis about modern theory of risk management, we can do an amazing thesis because I am very clear in this moment. In the discretional, there are several risks. For example, betting is a risk, but is a risk that it is not administrated in the companies because it is prohibited. So risk in the companies should be legal. So we will have usually financial risk as a discretional risk, but we have also, for example, in insurance or in annuities or pensions, technical risk, which is, for example, the mortality is a technical risk when we take an annuity or subscribe, underwrite an annuity or underwrite an insurance policy or a surety bond, which is also discretional risk. When we make a market campaign, it's a discretional risk, okay, like the bet. But depending on the expected results or the objective of the campaign is a financial risk or a reputational or strategic, which is an operational risk. So as the bet, depending on the objective that we are reviewing, we can match a market campaign as a discretional or a non-discretional. By themselves, the campaigns are not a discretional risk because the campaign do not generate by themselves losers or probably gains of clients or image or things like that. Maybe loss of image if the campaign is not well done. So it's something that it cannot be measured financially. That's why it is probably a reputational risk. But if we set the event as the investment of 1 million pesos in campaigns, that's a discretional risk because we are deciding to put the money in that project. And we need to assess if we win with that investment or we lose with that investment. This is also another similar example. Is it clear for you? Perfect.
Yes.
So in the class, we will review financial risk in risk management. In this class, we will review financial risk management, which have several categories, but we will review the three ones that you are seeing in the screen: market risk, credit risk, and liquidity risk. Three of them are different because measure different things. Until here, any doubt or comment?
I have a question. What would be liquidity risk?
We will see in the future, so be patient.
Okay.
But liquidity risk is kind of market risk, but depends on the consequence. Because the three risks could be measured in the same asset. This is something important. We will measure financial risk just in the assets of the company, not in other things, not on liabilities, not on capital. We can estimate capital with a financial risk part, but there is no financial risk over the capital, it's over the assets. And the risk in the assets that cover the capital or the equity of the company, that are the ones that generates the estimated cost of capital for a company. but this is more advanced and we will review deeply in the following classes. Again, if we have, for example, an stock in the market of Bimbo, and we buy the, bueno, ¿cómo se dice acción? One stock or one title? One title of Bimbo in 60 pesos. I do not know how much is currently the value of Bimbo, but let's think that it is 60 pesos. We have market risk, or we measure the market risk as the difference in the following day of the price. So if price is 61, the change in the price is 1 peso, and we have a gain of 1 peso, possible gain of 1 peso. And if the price is 59, we have the loss of 1 peso. But it is not a real loss. It is a loss in the value, but we are not materializing. So that's market risk. How much the price could change through the time, and it is just materialized when we sell. So we have market risk 1 day, 1 week, 1 month, 1 year in the long term. So it is the possible change in the value of the assets. That part is clear?
Yes.
And liquidity risk is a little bit more complex because use the same techniques or very similar techniques of the market risk, but measure the possible loss in the short term. It means 1 day usually, because we need to sell our assets to pay outflows of the company. So usually in liquidity risk, we estimate the change in the value of the assets 1 day or even hours, and the possible loss that we could materialize for selling quickly and not wait for the term of the assets. And when in a stock market, it is not so easy to see, but if you have a bond, for example, a SETE, and you buy it at 9.10 pesos, after 28 days, you expect to, well, after 1 year, you expect to recover 10 pesos, okay? That's clear for everyone?
Yes, so risk in liquidity risk is related with what was the word in English in mercado?
Market.
Market risk.
¿Me dices en español para entender la idea?
O sea que el riesgo del mercado está relacionado con el riesgo de liquidez.
El riesgo de liquidez se mide igual que el riesgo de mercado de corto plazo, pero tiene que ver con la decisión de vender para poder pagar flujos. Y
Okay.
el de mercado no requiere una decisión para materializarse. Bueno, sí requiere la decisión
¿En qué inviertes, por ejemplo?
de realizar el portafolio, ¿no? O sea, tú tienes un portafolio dado y lo que mide el riesgo de mercado es cuánto vale en cierto tiempo tu portafolio.
Ok.
Y lo que dice el riesgo de liquidez es cuánto volumen de mi activo tengo que vender al precio que esté en el siguiente día para poder hacer frente a mis pagos del siguiente día.
Ok.
¿Va? Clear for everyone? Well, so let me stop sharing this. And let's start the unit. Okay, Maggie. Okay, so we will start with CAPM, well, with the review of the market, the factors that, how I can say that, the risk factors that affects or define how we are going to measure market risk. But before, in the syllabus, we have to review the CAPM model to have like an understanding of what is a basket of assets in a portfolio and how we make an efficient frontier for this. Does anybody knows this model?
This is the Markowitz. It's from Markowitz model.
The efficient frontier is the theory of Markowitz or the technique of Markowitz. But before Markowitz, we need to know the understanding of the CAPM model, which is the one that says the returning of an asset could be great as a linear, could be right as in a linear regression. So, and estimates a constant called beta, which is the pendant of this regression, and says if the trend of the value of the asset is positive or negative. But this is something that you should review in financial mathematics too, I think, corporate finance, and maybe international finance, and several classes. So I could not lose my time reviewing CAPM model. And then think, because if you know Markowitz and do not know CAPM, you need to research more. So for that activity, I put in the classroom a video which explained clearly CAPM model, returning yields, and the risk. So please review for the following classes. It is preferable that you review before next Thursday to at least comment any doubt or comment. But if not, you have a lot of time, and in any moment we can discuss, but not embedded with the class, no? Just to clarify any doubt or comment. Is it clear for everyone, the instruction?
Yes.
Okay, it is already published. We will review, as I comment, risk factors in market risk. So we want the title that I put to this presentation. I will update because it's like an old-fashioned format. I will try to make like more attractive. So understanding key drivers of market volatility. You are seeing my screen? Yes. Yes. So what is market risk? The risk, we already make a definition of market risk, is the possible change on the value of a portfolio in some defined horizon of time. So this is something that it is very important to have clear. If someone is taking the class as not non-subscribed person, usually when Amos make the extraordinary, put a kind of question in that way. Which are the components of the market risk? And it is the portfolio, the horizon of time, the expected returns, blah, 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 blah. But it is very important because it's a question in multiple choice, and the one that it is right is the one that have horizon time. Okay, so measure, or it could be defined as the risk of loss due to the fluctuations in the market prices, affects equities, fixed incomes, commodities, and currencies, and cannot be eliminated through the diversification, but can be managed. Are clear these three statements about market risk? Talk me, because I am not seeing the screen.
Yes.
Okay, perfect. So second, we will have several key risk factors in market risk. It's something to understand well. Market risk in a portfolio and in an advanced way. This is the way that market risk is taught in a master degree. And I prefer to teach in this way because if I just explain the difference in the yields as in economy or in the normal program of the class, when you saw that you need to measure separately several risk factors, it is kind of difficult to understand why instead of one variable or a single variable, you need to analyze five, four, six, even more. So I prefer to go deeply in the theory of the market risk to be clear and have a very good level in the class instead of just explaining a simple manner. So in any asset, you can find several risk factors, not just one. And there are also others where it has just one factor. But it is important to measure all the factors and then aggregate the possible change in each factor to get the possible price of the asset. That part is clear for everyone?
Yes.
Can
Yes.
anybody give me an example of an asset that could have two of these risk factors?
Could be the premiums of an insurance company.
En español para que te entienda, porque
Ah,
luego
perdón. No, no, disculpe. Las primas de una aseguradora podrían ser tal vez.
¿qué riesgo tendría?
Como que el
O sea, ¿qué factores de ahí tendrían una prima de seguros?
equity, me parece, o no sé si.
Equity price, when we say the equity price, we refer to the value of a company.
Oh, okay, sorry.
A premium could have several risk factors, but have technical and financial risk. So it is a good example that one asset or one income could have several risks, but there is no, or not the one that I expected. It is not bad or it's not incorrect, but it's mixing also technical risk. So let me share an example of one factor, two factors, and that's it. Because can say other more, but well, for example, if we have invest in bonds in CETES, which is the risk factor of invest in CETES if we are a company in Mexico that has all the accounting in Mexican pesos. 1, 2, 3, 4, 5, or 6.
Mhm.
What?
The interest rate.
Interest rate risk. The only factor that changed the price of a bond is the interest rate. Okay. If we are in Mexico, we have our finance in pesos, and that's it. But if we have, for example, a T-bill or a treasury bond of the United States, we have two risk factors. Which ones?
Currency risk.
Currency risk and interest rate risk. So that's the way that we need to identify how many different effects we could see in the change of the price of an asset. We can measure as a joint variable the change without understanding how much risk comes from interest and how much comes from currency. And it is okay, but we are losing information. And there is also embedded in the marginal variables of interest rate risk and currency rate risk are dependency relationship between the independent variables to get the joint variable. And if we can model this dependency, we could make a very accurate model to measure change in the price of an asset. Is it clear that part?
Yes. I
And
have,
this,
I think I
yeah,
have another example. Like if we sell, I don't know, petroleum,
yeah,
we have commodity price risk
yes.
and currency risk.
Depending in which market we are selling and in which market are we, okay?
Okay.
But yes, commodity, of course, is the one that it is embedded to the petroleum. But if we are Pemex and we sell petroleum to Mexico, there is no currency risk.
Okay.
Okay. So, uh, just before go to the next slide, which is the function that measures the dependency between two independent or dependent marginal variables.
You meant the joint distribution?
Yeah, which is the relation between the marginals and the joint distribution.
The
Or even it's
dependent,
not the, come on, but more easier, which is the function that has the information of the relation between marginal variables and joint variables.
the copula function?
The copula function. So it's something we will not see copulas here because it is an advanced topic, but it is important that you start to see that have this kind of information, for example, the copula distribution or the copula function in marginal and joint variables, make very accurate or more advanced models than the ones that are commonly used in this moment. Okay? So for me, at least as a professor, it's very important to make that you get curious how you can apply the things that we will review in the class in a more advanced or sophisticated way when you work outside, because this is the things that make you a great actor. Okay? And I am not expecting that you understand how to estimate a copula here. If somebody can do it, okay? But if not, I am not expecting that you graduate making copulas as Dr. Arturo Erdeli, PhD Erdeli. But at least take advantage that we have that kind of professors in the faculty to try to understand and try to think how we can apply this kind of knowledge that it is very limited in the market. Usually, when somebody asks me what do I recommend as the key thing when you will start to work, I always say English. I think English is one of the things that open more doors to have good jobs or other language in general now. But it is easier speak English and then French, Japanese, German, Italian, Portuguese, whatever. But after that, what I have seen when you have some years working in a company, the key to grow in a company is to specialize in an emerging knowledge. It mean you not need to be a researcher because research is difficult, but it is also a nice activity. But you need to try to go deeply in the new technologies or the new knowledge and apply on your work. Is that part clear for everyone? Well,
Yes,
perfect.
but how? I mean, is there a way um, where you can relate the copula? I don't know how to pronounce this one, but I think that I will say it in Spanish. Hay una forma de relacionar la cúpula con, por ejemplo, el riesgo financiero.
Yes, of course.
We can use Sklar theorem.
Clark's theorem reflects the relation between marginal variables and joint variables. So the link is the copula, so that's the Clark theorem. But in any case where we can estimate marginals and joint results, we can try to estimate or to guess the copula that links the marginals to get the result in the joint variable.
Okay, thank you.
Yeah. So you, for example, currently in insurance, the way that we measure this and the way that it is teach in other classes is you use a Cholesky matrix to reflect the dependency between the assets. And we will review a little bit about Cholesky, but Cholesky matrix, it is a Nobel Prize article that was designed under the assumption that the returnings of the assets distributes normal. Okay, so almost all the theories of the market risk, it is created by economists and not by actuaries, assume several things like the preference are rational, that the residuals in the yields of the assets are close to zero in the long term and have quoted variance or limited variance. In the criticized assumption in these models is that they assume that the residuals of the CAPM model that you will review in the video that I share with you are normal distribution because they assume that it is a linear regression, simple linear regression. So we can estimate independently risk factors, and then we could estimate the joint return of a portfolio. And if we can find the function that relate marginals with the yield of the portfolio or the joint yield, we estimate the copula that links independent variables or marginal variables, marginal risk factors with the whole portfolio risk. Is it clear for everyone? Okay. So just to read quickly, we have equity price risk, which is the change on the prices on the market assets, interest rate risk, which it is usually related with credits or bonds, currency risk, that I think it's easy, is the relation between two currencies, for example, euro, dollar, yen, yuan, sol, peso argentino, etc. Commodity price risk, it refers to the price of a good or a good or in a primary activity. For example, coffee, corn, oil, petroleum, uh, gold, zinc, iron, any good that we know that itself in a commodity market, we could have commodity price risk. And why do you think that equity price risk is different of commodity price risk? In Spanish is okay.
For example, when the market is, well, I can remember that when when the oil gets very expensive because of political tension and the price of it can go up or lower because more like a market risk about how volatile is and how much you can lose of not buying it when the price is at its um highest.
Okay, these spikes or strikes. Yeah.
So it's like aranceles.
That's a factor, but it is not the nature. The two things that you are saying is the systemic and idiosyncratic risk. What is the actions that affects all the market, and whilst for example, the actions of the proper market, for example, the increase on gold and silver affects the stock market. Eh, and for example, the tariffs, which is aranceles, affects commodity particularly, and some industries on the stock market or the equity price risk. But that's idiosyncratic. There is no clear relation when, for example, Trump makes a declaration. That's idiosyncratic. But systemic for sure is if China restricted the deliveries to America, that's systemic risk. Okay. So returning on what make the difference between equity and commodity, equity price risk is based on the preference of the investors. Okay. So if investor says or believe that OpenAI is a good company or NVIDIA is a good company and they decide to buy the assets in a higher value, the value of the stock increase. And if they have fear that Apple is not innovating, they decide to they invest or not buy new actions, so the price of Apple decrease. So equity price risk is different from commodity because equity comes from the preference of the investors, and commodity comes from the preference of. It's a question.
Government.
Could be government, but not just government. There is a wider group that
Supply and demand um, laws, I guess.
more or less in both is supply and demand, but in equity supply of demand of the investors, and in commodity supply of demands of the consumers. Okay,
The consumers.
so this is microeconomics and macroeconomics. Clear for everyone?
Yes.
Yes,
Okay.
it's
As I comment, to have better understanding on this class, try to read something about the topics that we will be seeing in the following classes to go more deep in the knowledge that I am sharing. And of course, you can read in Spanish or in English, could be better, but you have a better previous understanding of the topics that we will be talking. So equity price risk, the risk that the stock prices will fluctuate to the market conditions. It's driven by macroeconomic factors, GDP, growth, inflation, corporate earnings. As an example, the stock market crash in 2008, okay? If have doubt or comment, please stop me, but I will try to go fast to end early the class today. Interest rate risk, because it is a lot of topics, not because I do not want to have more time in the class, but maybe we can discuss any other things, but not go deeply in the knowledge. Interest rate risk, the risk that bond prices will change due to fluctuation in interest rates. And it is not precisely just bond prices, it is fixed income instruments, but to do it easier, I refer to bond prices. So there's several statements here. Higher interest rates means that bond prices decrease. It's an inverse relationship, okay? It is very important for fixed income investors and for financial institutions. So because they need to invest a lot of money in fixed income, okay? And the examples of risk factors is central bank policy change, or well, decisions that affect this risk factor is central bank policy change, and that affects bond yields. So that's why we start the semester reviewing macroeconomics, because several times macroeconomics affects the risk factors in market and in general in financial risk. Is it clear for everyone until here?
Yes.
Okay. Currency risk, also called exchange rate risk, is the risk of losses due to the fluctuations in exchange rates. It means how much change dollar against peso, how much change euro against peso colombiano, etc., etc., etc. Affects multinational companies and investors holding foreign assets. It means just exists when we have exchange between our providers, buyers, or group companies and need to change the assets through other currency, okay? As an example, a Mexican exporter losing competitiveness due to the peso appreciation, okay? Because if peso appreciates, it's go higher the price when they sell in the States, because it is usually the price fixed in dollars. So to compensate the real price in pesos, they need to increase in dollars or lose. Is it clear that part? Because it is a difficult example.
Yes, like China takes the decision to make their yen devaluated because
Yeah,
of
exactly. But maybe to be very clear, I will explain in Spanish that part because it is hard. I try to think in English and it's hard for me. Nosotros somos un vendedor de tortilleros y nos cuesta hacerlo aquí 10 pesos y no ha cambiado y lo vendemos en $1, el tortillero en Los Ángeles. En México no pasa nada porque mi precio sigue siendo 10 pesos para producir. Y el año pasado yo ganaba 20 pesos por cada tortillero cuando lo vendía, ¿no? Pero ahorita el precio del dólar está en 17. Entonces, si yo mantengo fijo el costo a $1, en vez de ganar 20, gano 17. Por eso que el peso se aprecie hace que un exportador pierda competitividad. Lo que tendría que hacer es ahora venderlo en 1.30 para que siga teniendo mis 20 pesos. Is it clear for everyone?
Yes.
Perfect. So, regarding commodity price risk, this is the risk that the commodity prices like oil, gold, agricultural products will fluctuate, affect industries reliant on raw materials like energy, agriculture, or mining. And as an example, oil price volatility impacting energy companies. So I think this part is clear because it is analogous to the stock or the equity price risk, but with raw materials. Liquidity risk. This risk is the risk of being unable to buy or sell an asset without affecting its price. And we will see separate. Higher in markets with low trading volume or during financial crisis. And as an example, in 2008, the crisis, investors struggled to sell mortgage-backed securities. So this make that rates increase like madness. And there are some institutions that go to bankruptcy. But I had a best example of liquidity risk on Silicon Valley. We will review in the following class with Silicon Bank, I think it's called. So then managing market risk. There are several strategies to manage market risk. One of them is hedging, using derivatives, options, or futures to reduce exposure or volatility. Diversification, which is spreading investment across asset classes and regions, especially for multinational companies. Risk assessment models, which is the one that we will review in the class. We are focused on understand the techniques to measure financial risk, and we will review some risk assessment models like value at risk or the stress testing, and also monetary and fiscal policies. When we are the government, we have central bank actions to affect market stability, as the case that your classmate comment about the depreciation of yuan. Comments or doubts until here? Are you familiar with all the words that are put here?
Yes.
Okay, give me 1 minute. Okay. That's it. I think I have another one, but that's it. So, from my side, I think for today it's enough discussion or comments because we saw the introduction of financial risk and also share the market risk factors. I don't know if there is any comment or question. If not, I think we can close here the class. If you have any doubt, I could remain a few minutes to uh, check doubts or comments, but if not, you can maybe go to have breakfast or anything you need to do. Okay?
Thank you, teacher. Good
Yeah,
night.
thanks to
Thank
you.
you.
Have a great weekend.
You too. Thank you.
Thank you.